Hello, Crypto Breakdown audience, family, friends, whoever you are. Happy holidays for one, and thanks for tuning in to another episode of the Crypto Breakdown podcast. Today we have a great episode, actually, very beneficial for me, and I have a feeling it'll be very beneficial for a lot of my followers as well. We're talking with a man named Sterling. He's from California. He's a wealth advisor. He has a lot of tips and tricks to lower your tax burden, basically. He's got things like opportunity zones, investing in oil and gas drilling, and then we discuss things like starting an S Corp or LLC to see what other benefits lie in those possibilities. After we talk to Sterling, we've got James from GK Real Estate coming on, who actually is in the process of raising money for an opportunity zone investment. So Sterling's going to give you the rundown on an opportunity zone, what it is, and how you can use it to lower your tax burden. And then James is going to talk about a project that he's actually in the process of raising money for. So if you do qualify and this is something you're interested in, you could get in contact with James and talk to him about getting involved in this opportunity zone investment. Both of their contact information is listed below. Do your own research, of course. Make sure you research Sterling and make sure you're happy with who he is if you want to work with him, and make sure you research GK Real Estate and the things that they've done if you think you're going to be interested in working with them, just the same way you would research any other investment that you do on your own. For what it's worth, I've talked with both of these gentlemen off the air numerous times, and they both seem like great guys. So if you have any questions for any of them, I don't think it would be a problem if you reached out to them and spoke to them directly. They're both open, they're great, and they're very good at what they do, as far as I can tell. So that being said, I hope you guys enjoy this conversation. I thought it was very interesting and very beneficial, and I plan on taking advantage of some of these things because I do have a hefty tax bill coming my way. That being said, happy holidays, enjoy this conversation, and I'll be back soon. See you guys. All right, guys, I'm very excited for this conversation. Today we're talking with James from GK Real Estate and Sterling from financialarchitects.com. How are you guys doing? Is everyone doing well?
Doing great. Doing really well.
All right, so I kind of feel like that the crypto bull market might be ending in the next 6 to 8 months. So I've already started preparing for that, and I've made some sales. And so suddenly I've got this large tax burden. And so I'm happy that Sterling came on. Maybe we can talk about some taxes and stuff. Is there, I don't want to get into the opportunity zones yet, but is there anything that people can do to minimize their tax burden? I know a lot of people think that they can like start a corporation or an LLC and that'll magically lower their tax burden. Is that something that's possible?
Well, starting a corporation or an LLC definitely allows you some latitude on your taxes. This form two of them, one with an off-year election and the ability to transfer between those entities so you can manipulate your tax position as to when you pay the taxes. And having a corp often allows you to run business expenses through that entity that might look a little more suspicious on just a regular 1099 situation. So it does help.
So if I have this newsletter and this podcast, I could start an LLC, but I don't know if this is right, but I was under the impression that if I start an LLC, the process of transferring my assets into that LLC is a taxable event. Is that correct?
No, it's not. It's a disregarded entity. It basically, it'll have its own tax ID, but essentially you and the LLC are one in the course of things. So it's you'll file under a separate tax ID for that entity, but you usually will run some type of payroll or compensation schedule out of it, and that will allow you to, many cases, deduct insurance premiums, deduct business expenses, education, A lot of things that you might want to do to further your professionalism in whatever you're doing. Um, you can run car expenses through it if it, on a lease or a vehicle over 6,000 pounds. You can put family members on payroll, especially, children that are old enough to work can receive income at what would probably be a lower tax bracket than you are personally, and they don't have Social Security taxes that they would be required on a self-employment basis. So there's a lot of flexibility. You can also, run some advanced qualified plans, through that entity. You can do that on your own, but you need to have, some type of payroll. And IRS looks most suspicious at companies without payroll, just trying to remove the self-employment tax. So you have to run some type of payroll through yourself and pay yourself as a professional.
Just to keep the magnifying glass off of you, I guess. Just try to minimize the chances of getting audited.
You definitely want to do that. You don't want to, the help of a good accountant to help you keep books and records. I know there's specialized software out there in the crypto world that allows you to do that trade, and especially as more and more crypto people get into electronic trading in the crypto world, where one of my clients actually had 26,000 trades, on her accounting. So, your world is getting quite complicated and very quickly advanced in this area.
Do you, in your experience, is the IRS like giving special attention to people that are involved in crypto?
I don't know anyone that has seen that yet, but I know that the SEC is taking a large interest and that the government is starting to try and regulate that environment, especially if you look at the most recent Biden bill, which actually clarified how crypto is going to be taxed. From one of the things that was an issue was whether going from an NFT to a stable coin was actually a taxable event, because you went to one from one non-currency to another, and there was questions surrounding that. Most recently, they clarified that any transaction is basically a taxable event where there's a gain. So, I think the government definitely has an interest in some type of regulatory oversight. And particularly the SEC is taking a great interest in it now.
Yeah, I'm pretty sure, at least in this new infrastructure bill, they extended the $10,000 transaction reporting to now include cryptocurrency, which is going to be that's a pretty big headache if that goes into effect, because people are transacting tens of thousands of dollars multiple times a day, it seems like. So I don't know if you have any thoughts on that, or if that's even, practical to go into effect.
I can't speak to that yet. There isn't a lot of clarity in this bill just passed, so I haven't fully had the opportunity to digest what's going to happen there and how they're going to handle the regulatory environment. I would just happen to say that it's definitely coming, and they're trying to catch up.
Yeah, for sure. I mean, it seems like it's in the news all the time with the SEC. So is there any obvious things that we can do other than starting an S Corp or an LLC to lower our tax burden? Is there any, for some people out there that might be sitting on large sums of money, is there any special products that they could, be looking into?
Yeah, so if they're interested in diversifying out of crypto, I think we're entering into a commodity super cycle. So I think that, there's interesting opportunities in the oil and gas space, which allows you for deductions of intangible drilling costs. Usually, those types of programs allow for 80-cent deductions for every dollar that's invested in that space. and it is. I think it's a unique opportunity to take advantage of the inflation that is here, and I think going to accelerate in the near term. So it would be an alternative space in which to make an investment and receive a deduction. Also, and there are certain investments which will have accelerated depreciation, which you can offset crypto gains with. Um, some types of real estate allow for under the Jobs Act deductions of accelerated depreciation. So there are things to invest in, as well as you can make qualified plan contributions, and obviously anything into a qualified plan is 100% deductible. It allows you for some diversification of other investments.
So your comment on commodities is interesting to me. I've been eyeing up uranium for a while, which is a whole long story in and of itself. But like, what would that look like if I wanted to invest in oil drilling? Like, I don't know. I'm just kind of confused. Is that like a fund that you contribute to?
Well, normally they're basically limited partnerships where you take an active participation in partnership and you become a part of the drilling group. And as a active member in that LLC entity, or I should say general partner, you are allowed those deductions, and they will give you active write-offs, and you're basically paid for whatever comes out of the ground, whether that's oil or gas. Typically, you'll invest by the end of the year, take your deduction, and you will see some type of income, depending on whether we're talking about dry gas 6 to 10 months later, or if we're looking at oil, you're going to be looking closer to a year before you would see any type of distribution come off of that drilling program.
And is this something available to the average person? Because I don't know the first thing about drilling for oil.
Yes, they are available out there in partnerships out there in the marketplace. They do have substantial risk, and they're only for accredited investors. But there are some really good programs out there.
Okay. Why don't we get to opportunity zones? Can you tell our audience what an opportunity zone is?
Again, a piece of legislation that was started the Jobs Act. It was actually authored by Cory Booker, and I don't recall the Republican's name on it, but it was originally came out in 2014 under Obama, and it sat on his desk, and they didn't do anything with it. When Trump came in, he put it as a part of the 2017 Jobs Act. It comes under Section Code 1400Z2. It simply has identified zones around the country which have been designated as underdeveloped or in need of redevelopment. And it was based on the 2010 census data. So in that time, since the recovery, a lot of things have changed. There's some really great places which fall into opportunity zones across the country. Area that particularly is boomtown is Phoenix, and large portions of Phoenix are opportunity zones. But these places are all over the country. Sarasota, Florida, for instance. Reno, Nevada. Pretty much the entire town of Reno is an opportunity zone. So there are plenty of both primary, secondary, and tertiary markets where there are great real estate opportunities on a developmental basis in which to invest. And the rules are essentially you either have to take an existing property and do a 50% improvement on it that sits in an opportunity zone, or you have to do new construction build something that is an improvement to the area. That could be an office building, multifamily, um, some type of business. I know of a couple of companies that have built a new headquarters and threw it into their own opportunity zone. So there's a lot of unique opportunities out there for developmental real estate, in which you get to defer your gain and receive an initial forgiveness, and I believe this year is still 10% on that gain, and defer that gain, just the gain. Uh, and that's really unique. Most investments in real estate require you, if you're selling an asset, particularly real estate, and do a 1031 exchange, you not only have to defer the gain, but you have to defer all of the basis. Uh, Opportunity zones allow you to just scrape off the gain and defer only that and keep your basis in your pocket. So it's a unique piece of legislation that is supported by bipartisanship of both sides of the aisle. So I don't think it's going to go away with anything that Biden does now or in the near future.
So, correct me if I'm mistaken, but let's say I turn $100,000 into $150,000. That's $50,000 of capital gains. I can put that into an opportunity zone, and I'll never have to pay capital gains on that 50,000, or I have to pay it 10 years down the line.
Well, technically, there's a recapture in 2026, at the end of 2026 of the original basis, but there's a couple of ways to not worry about that, and one is the fact that you can refinance that gain back out and through tax-free distribution on a refinance, and that can pay for that gain. But you would have an opportunity to offset that gain with depreciation that comes off of real estate, and all real estate allows for a level of depreciation, and some of that gain that would come back would be offset by depreciation, and in many cases all of it potentially could. But otherwise, if the real estate that you're investing in doesn't offer that type of depreciation, then you would have the ability to refinance and pay that gain at that time with tax-free distribution, and you still own the real estate, and all of that appreciation that occurred in that real estate will never be taxed. So there is significant benefits on it, and if the developer or you or whoever is basically running the opportunity zone that you have is smart about how they position the financing and the leverage on that, you may never have to pay the gain.
Okay, so that original investment, if you can't find the right way to do depreciation or something like that, that might get taxed. But any profits from that original investment do not get taxed no matter what.
That's correct.
Cool. Interesting.
If you hold it for 10 years.
If you hold it
That's
for 10
correct.
years.
If you hold it for 10 years. And you would, you'll, depending what year you come in, you will get some type of initial forgiveness of 10 or 5% on a rolling basis of the original gain. So if you had a $50,000 gain, I think this year you would actually have a 10% deduction on that. So you would actually only have to record a $45,000 gain on recapture.
Wow.
If there was one.
That's nice right there. Not even the other stuff.
Right.
So
but
James, you can continue.
You want to think of this almost like a super Roth, in the sense that, very few things you can invest in and never pay the tax, or never have to pay the tax. And technically, you have to hold it for 10 years, but most people hold real estate for a long time, and that appreciation will continue to appreciate. In fact, it doesn't really end until 2036. Correct me, James. 2036 is not
Yep,
when
I think so.
yeah. And at that time, all of that deduction that you took, all of that income that comes out, a lot of which would be tax free. Uh, that basis will start over again. In other words, all the money that you took up they will step up the basis back to the new present value, and then you get to start that same depreciation schedule all over again. So it's really a unique piece of legislation.
What was that about 2036? Is that when the opportunity zones are done?
That's when they're supposedly done if they don't get extended. That's when all of the real estate that's actually kind of in the fund, that shell will terminate, and the real estate will come out. But at that time, it receives a new step up in basis, assuming that you didn't sell it before then. And so whatever that appreciated to, so your $50,000, let's assume it multiplied 6 times, and it's now worth $300,000. That real estate will step up to basis to whatever that new value is. It's worth $300,000. It steps up at that time, and now all of the depreciation that you previously took, as real estate is depreciated, its taxable base goes down. Well, it starts over. You can start using that same depreciation schedule, and that income that was coming off of that real estate will be offset by depreciation, and so likely you wouldn't pay taxes on that income for 6-10 years.
Wow.
So it's
At this point in time, Sterling's internet connection kind of it got cut out. So we are going to fast forward to the next question. I realized that I left you with an incomplete answer to that last one, so I could have just deleted the whole question and answer. But honestly, Sterling is so packed with information that I thought even an incomplete answer would be more of a benefit than not hearing it at all. So here we are, forwarding into the next question. So that's, a lot of interesting news and information for me, because I've got a hefty tax bill coming down the way. So hopefully I can take advantage of that. But James, why don't you come in here and tell us what you've got going on?
Yeah, thanks, Matt, and thanks, Sterling. I think opportunity zones are really exciting, particularly for crypto and stock investors, because there are a lot of tax advantaged investments out there for real estate investors with real estate gains, but there are not as many for people in the crypto and traditional equity space. So the opportunity zone offers a very unique benefit in that, when we look at your example of someone with a $50,000 gain, you can put that in an opportunity zone, and now that's your basis in this investment. And in 2026, 2027, most of these funds are doing is they're doing a cash out refinance, and they're giving investors cash to pay their capital gains with, which have now been reduced by 10%. So you pay your capital gains, and now you're in this real estate investment, and it's producing cash flow. So you're getting regular income now as it's stabilized. And then after 10 years, when you sell it, however much it's appreciated, you get to walk away without having to pay any capital gains on that. And so that whole cycle is an actual, exit. When we look at real estate investment where you're trying to avoid taxes like the 1031 exchange, you have to continue to exchange properties over and over again to avoid and keep continuing to defer those taxes. So the opportunity zone is very special, and we're really excited about it. And so a little background on us: GK Real Estate. We're a real estate development and investment firm. We've been around for 25 years. We've bought, managed, leased, built, developed, all asset classes in the real estate space. And right now, what we're here to talk about is we just closed on a piece of land in Sarasota, Florida, which is an opportunity zone. So we love the Sarasota market. We were actually building a 36-unit condo building right now, and while we were under construction, we saw this site come on the market, and so we just closed on it. And so the site is 1.4 acres. It's right off Main Street in Sarasota, Florida. It's zoned for multifamily for residential. And so our plan is to build an apartment building on the site and offer investors a chance to take an equity position in this development through the Opportunity Zone, Qualified Opportunity Zone Fund. So, when we saw this site, this is the kind of site that we would develop if it wasn't in an Opportunity Zone. It's a great location. It's in downtown. It's zoned where we want it. Sarasota is the number one place to retire in America, the number two one of the fastest growing cities in the U.S. They can't build density fast enough to keep up with the amount of people moving there. So we would be doing this development regardless. And then the icing on the cake is that it's an opportunity zone. So we right now are planning to build around 140 units, multifamily. The offering is currently a $13.5 million raise, where we are offering a projected 8% preferred return accrued. So that means as soon as you invest in the fund, your money is now earning 8% annually, which accrues because first, obviously, we just actually purchased the land, but first we would then need to build the apartment building, lease it up, and then once it's stabilized and it's producing revenue, you would start to get paid that 8% return. So all of that's going on, and the plan for us is that in 2026 we would refinance the property and generate cash from that, and that cash you'd receive that cash to pay your capital gains. Then you would continue to hold the property for 10 years, and we would sell it at the ultimate price that it sells at resets your basis, and all of those gains that you made all that time, as it's a appreciated value, are not taxed. So and when we exit, so you're getting an 8% preferred return throughout it, and then when we sell the property, the gain on sale, 80% goes to investors and 20% goes to the developer, which in a typical development deal, you'd see around a 50-50 split. So this is an even better split for investors.
And where does this 8% come from? That comes from the rent from the tenants?
Yes, so that comes from the rent from the tenants. And actually, if the rent generated from the tenants exceeds the 8% preferred return, the investors would get an increase on that projected 8% over that. And given the projected rents we have in the market and the current increases in rents we're seeing in multifamily, that is a potentiality for the property.
So between whenever someone invests and all during construction, that 8% is not coming in, but then the assumption is the building will fill up, and as soon as that happens, the 8% starts going out, whatever, monthly.
Yeah, so it's accruing. You're earning it the whole time. So then as soon as we start generating cash flow, it's catching up on you. And so part of that will be paid back when we do the cash out refinance. And then alternatively, as Sterling said, we can also do a cost segregation analysis, which is where we basically accelerate the depreciation on the property, and we allow investors to take it as a loss, which then they could use to offset their gains as well.
Interesting. So you guys already have a property in Sarasota that's scheduled to be completed, or it already is completed? Is that correct?
So we purchased the dirt. Actually, 3 weeks ago, we closed on the dirt. We've already begun raising money. The fund is currently open to investors. Right now we will move through raising the funds for the money, for the fund, and then eventually move to construction. We've got our architect, which is Hoyt Architects, a local architect in Sarasota. Our contractor is Gilbane Construction, which is actually located across the street from the site. They've been building in Florida since the 70s. They've done a lot of multifamily. Then we have our property manager, which is JMG Realty. another large group they'll be responsible for managing the property and leasing it up. So as the process moves forward, we then intend to start construction in late 2022, 2023. Take several years to build it and lease it up, so the property stabilizes in 24, 25, and then we hold it out through 10 years, looking at a 2031, 2032 sale date.
Sterling, do you know how long I have to reinvest capital gains until I'm not eligible to do this? Because I have some crypto sales that are probably 3 to 4 months old now. Is that too far back?
No, you have 180 days.
Oh, wow. So like 6 months. You could call it 6 months, I guess.
Yeah, and if you know somebody skilled, then potentially there's ways to play with the dating legally. So nothing I ever do is either immoral, illegal, or fat things. So so there's plenty of ways to do that. And you also have, if you were in a partnership and that partnership issues a K1, then you actually are able to use the date of the K1 filing as your sale date.
Interesting. So, James, let's say someone wants to invest, this site that you guys are doing, you're kind of just overseeing the process. Like, you're not actually doing the construction. You're not managing the tenants. You're just kind of putting it together and hiring outsiders to do the dirty work. Is that correct?
Yeah, as the developer, we oversee everything. We make the final decisions on everything, but obviously we're bringing in experts. We bring in an architect who is experienced in the market, experienced with these building types. Same for the contractor, same for the property manager. But ultimately, everything comes up to GK Real Estate to make the final decisions on everything.
Since it's an opportunity zone, does that mean you have to cater to a certain demographic? Like, is this meant to benefit lower socioeconomic people, or is this you can build whatever you want as long as it's in an opportunity zone? Does that make sense?
The way the land was chosen is supposed to have political reasoning behind it, and there are qualifications which you can look into further on how tracts of land were chosen for the opportunity zone. But once they're designated, really our ability to build is whatever we can get permit approval from the city for and whatever the zoning is. Okay.
I just didn't know if it's, it sounds like it's meant to improve neighborhoods. I didn't know if that meant you had to target a certain demographic of people. On your prospectus, or whatever you want to call it, it says, if the proposed changes are not enacted, there's a strong market demand for a hotel. And we were talking off the air that you might get clearance to build additional units. Does that change the investment at all for any prospective investors?
The investment is the same regardless. The fact of the matter is that we're currently zoned today to build 69 units, and that only uses half the site. We're also zoned to build a hotel. So when you'd originally gone to acquire this property, we had plans of doing a side-by-side development of an apartment and a hotel. Then COVID hit and hotels have become difficult to finance, though we do believe that industry will come back. And the city has so many people moving there that they have enacted their own plans to increase the density for the entire Sarasota downtown. They're meeting in early next year to vote on approval of the density increase, which would automatically double our ability to build apartments on the site. So in our original offering materials, they show these multiple paths forward, though at this point we're looking at it most likely being a all multifamily on the site.
So does that just mean you're going to raise more money if they do allow you to build more apartments, or does that mean the return is potentially higher or anything like that?
If we build more apartments, given what we know right now about market's appetite for multifamily, obviously things change 10 years down the line. It would the size of the investment does typically increase or lower the cap rate. So we do think that it would be more lucrative to build more apartments. But ultimately the fund can increase the amount it can raise depending on what we end up ultimately building, and the amount we borrow versus how much we raise is kind of a moving target as everything settles down with the construction costs, the precise layouts, and the mix of if we have some retail on the ground floor, how many units, etc.
Can you tell our audience what is a cap rate for anyone that's not familiar?
A cap rate is a capitalization rate, and it's the way that we calculate value in real estate, where we look at the cash flow that the property is generating as a ratio to the sale price that one would buy it at.
Okay. And you were saying you think Sarasota is a pretty good market to be doing this in. So
yeah, we absolutely love Sarasota. That's why we were surprised to find that the site was even an opportunity zone. It's just a very fast-growing market that has a business-friendly city, a business-friendly state. It's a place where people not only are moving to retire, but are moving to have summer homes. There's actually a tech scene that's growing in the Sarasota market. We're seeing more businesses move there. So by every metric, we really love the Sarasota area.
Do investors have to be accredited to do this?
Yes, this is a Reg D offering, so it is for accredited investors only.
Do you or Sterling happen to know what the qualifications are to be an accredited investor?
Yes, if you're married, it's a net worth of $1 million or more, or $300,000 worth of income. If you're single, it is half the income requirement, but the same net worth requirement, and that does not include your home.
Okay, it's a pretty high standard, but crypto has done well, so I'm sure there's some people out there that would qualify for that. Is there anything else you want to add about this opportunity, James?
I think, there's a lot of details in it, but it can be simplified with a short conversation depending on everyone's position and needs. So I'd be happy to share my contact info, and if anyone wants to reach out to find out more, I'm always around to discuss.
Yeah, I'll be honest, this seems like a really interesting opportunity. I mean, Sarasota, Florida. I don't know much about Sarasota, but I know Kathy Woods. She just moved her entire fund to St. Petersburg, which is only 45 minutes away. So I have to imagine that's, a good sign that huge, tech funds and tech companies are moving there. Plus, it's Florida. Florida seems to be pretty popular right now amongst people moving and older folks and all those things.
Yeah. And I think ultimately when we look at the crypto community, there's so many people from all walks of life that have made tremendous wealth in crypto, but I do see a trend towards it being younger people who are kind of less connected to that traditional world of finance and the people like Sterling, financial advisors, and that network where a lot of interesting and unique investments that are tax advantaged are kind of spread through that communication network. And I think a lot of people in crypto, they could benefit from a lot of these ways to diversify or protect their gains from taxation and in looking at these different sectors.
Yeah, for sure. I know there's a lot of people that are in crypto that really have no, background knowledge on investing whatsoever. So they might not know any of this stuff even exists. One thing I did want to ask, just coming from crypto, like we have to be super, I don't know what you want to call it, super cautious because there's so many scams and all of these people out there. So what type of investor protections are involved in something like this? I'm sure there's all types of like legal paperwork and things like that, right?
Well, these are regulated offerings, and so you're really being protected by the laws of the United States and the SEC. So when we create, for instance, a Reg D offering, as we call it, there are certain standards and reporting requirements and transparency that is something that I think crypto people are probably not so used to.
No.
All of the investor protection rules and regulations of the SEC, we're all under that umbrella versus the Wild West of crypto where, there's also anything goes and you don't really know who you're dealing with sometimes. So obviously you can research our company, you can look up our filings online and know a little more about us. But it's, more the traditional way of investing where everything's, under very strict rules from the government.
Yeah, it's a very nice change of pace to not have to constantly be concerned you're getting scammed. So if people are interested, where can they find you, and how do they get in contact and all of that? How do they go about doing this?
The easiest thing would just be to give me a call or an email. I can attach my contact info afterwards. We can share our website, which is www.gk-re.com. And I'd be happy to talk to anyone who wants to know more.
That would be great, and I will put that under the newsletter. And Sterling, if there's, are you accepting clients if anyone out there is looking for tax help?
Yes, we do accept clients. Usually, we're looking for people with a couple $100,000 or more in some type of taxable problem. Um, you know, uh, and for people that have substantial capital gains, if they're looking for something outside of Opportunity Zone, then we really need something with $1 million or more attached to it from the standpoint of those types of gains. Other than the oil and gas that we talked about earlier, those types of investments, we can operate on smaller gain issues that way.
So if somebody does fall in that category, how can they contact you for further information?
Our phone number from our office is 626-844-1190, and I can always be reached by email at sterling@financialarchitects.com.
That's great. I will put all that contact information underneath this podcast. And I thought that went well. I appreciate you guys coming on here, and I know a lot of the audience is going to find benefit in this.
Thanks a lot for the opportunity.
Yeah, thanks, Matt. Really appreciate it.